Hey everyone, welcome back to Corporate Decoder, where we demystify the inner workings of the corporate world. And today we're diving into a filing that's got some rather interesting numbers, especially for those tracking volatile markets. This is a certified shareholder report for Volatility Shares Trust, and it's like a yearly checkup for their funds. Now, they've actually amended a previous filing to correct some details about costs, which tells you they're not afraid to own up to numbers. Let's break down what this document tells us about the 2x Bitcoin strategy ETF, or BuyX as it's more commonly known. For the year ending February 28, 2025, they report a total return of 3.74%. This is an ETF that aims to double the daily performance of Bitcoin. So when Bitcoin goes up 1%, BitTEX aims for 2%, and when Bitcoin goes down, you guessed it, it aims to go down 2% before fees. Here's a crucial part for anyone thinking about investing. The report details the cost. For a hypothetical $10,000 investment in BitX, the cost came out to 235%. That means for every 10 grand invested, you're looking at paying about 235%. That means for every 10 grand invested, you're looking at paying about 2055%. That means for every 10 grand invested, you're looking at paying about $2055 time. These costs can really eat into your returns, especially with leveraged products like this. Now for the big picture numbers. As of February 28, 2025, the fund had net assets of over $2.2 billion. That's a massive amount of money, showing a lot of investor confidence, or at least a lot of interest in this particular strategy. Looking at what they invested in, it's pretty straightforward. They're heavily involved in CME Bitcoin futures with significant holdings in contracts expiring in March and April of 2025. This is their primary tool for trying to achieve that 2x daily exposure. Then we have the 2x Ether ETF, or ETHU. This one covers Ether, and the news here isn't as rosy for the past year. For the fiscal year ending February 28, 2025, ETHU had a total return of a whopping negative 80.65%. That means for every $10,000 invested, you'd have lost over $8,000 in this period. You'd have lost over $8,000 invested. You'd have lost over $8,000 in this period. This is a critical warning sign about the risks involved with these leveraged crypto-linked ETFs. The report mentions that Ether returns were affected by several factors, but the bottom line is a massive hit for investors. Despite this huge drop, the fund still held over $600 million in assets. This suggests that either there were substantial inflows from new investors, or the outflows weren't as severe as one might expect after such a performance. It's a bit of a head scratcher. Similar to BitX, ETHU also uses futures contracts for its exposure, with large positions in March and April 2025 Ether futures. It's the same mechanism, but with a drastically different recent outcome. Let's switch gears to commodities. The 2x Corn ETF, or CARX, for the year ending February 28, 2025, reported a positive total return of 12.38%. This fund aims for twice the daily return of corn. The costs here were much lower, just $46 for a $10,000 investment, or 1.85%. This is a noticeably lower expense ratio than BitX and ETHU, which is always a good sign for investors. As for investments, CoreX is focused on corn futures, specifically the May 2025 contract, where they have a significant position. Next up is the 2x Wheat ETF, WHTX. For the year ending February 28, 2025, its total return was negative 2.80%, not a great year for wheat either, based on this filing. The costs for WHTX were similar to CoreX, around $43 for a $10,000 investment, or 1.85%. Again, relatively low costs. Their investments are centered around wheat futures, with a focus on the May 2025 contract. Now let's look at some of the expenses. For the 2x Bitcoin strategy ETF, the net advisory fee alone was over $38 million for the year. That's a substantial amount, highlighting the cost of managing these complex ETFs. Moving on to the 1+1 series like the Nasdaq 100 and Bitcoin ETF, or RQB. This fund aims for Nasdaq 100 returns plus Bitcoin returns. For the short period it was active February 18 to February 28, 2025, it reported a negative 16.96% total return. The costs reported here are incredibly low, just $20 for a $10,000 investment, or 0.75%. This is significantly lower than the other ETFs, which might be a strategy to attract investors in a competitive market, but it also makes you wonder about the sustainability of such low fees. The net assets are also quite small, around $1.2 million. This is very typical for newer ETFs, but it's still a much smaller operation compared to BXX. Their portfolio includes Nasdaq 100 Micro E-mini futures and Micro Bitcoin futures, indicating a strategy to get exposure to both asset classes. Similarly, the 1+1 S&P 500 and Bitcoin ETF, or OSB, for the same short period reported a negative 13.99% total return. The costs here are also a very low 0.75%, identical to OQBIG. But again, very low net assets, around $129 million, very similar to EOQB. Their investments are in S&P 500 Micro E-mini futures and Micro Bitcoin futures. Finally, let's look at the Volatility Premium Plus ETF, ZVOL. This fund aims for the inverse daily return of the S&P 500 VIX Midterm Futures Index. For the year ending February 28, 2025, it had a negative 2.90% total return. The costs here for a $10,000 investment are $133 or 1.35%. This is better than the leveraged crypto ETFs, but still a notable expense. The net assets are around $19.7 million, which is modest. ZVOL's strategy involves VIX futures contracts with holdings across several expiration dates, including June, July, August, and September 2025. When it comes to the audit fees, the total for the year ending February 28, 2025 was $91,000. This is paid to Tate Weller and Baker LLP, and it generally covers their work auditing the fund's financial statements. It's a standard cost of doing business for these regulated entities. Diving into the actual financial statements, we see the detailed breakdown of what each fund holds. For the 2x Bitcoin strategy ETF, it's heavily weighted into money market funds, almost 43.3% of its net assets. But look at this, it also has over $5.2 billion in reverse repurchase agreements. This is a significant amount, essentially short-term borrowing, and it's used to collateralize their futures contracts. And speaking of futures contracts, on the 2x Bitcoin ETF, they have a negative unrealized appreciation of over $636 million. That means the futures contracts they hold are currently worth much less than they paid for them, which is a direct hit to their performance. For the 2x Bitcoin strategy ETF, net investment income was a loss of over $8.6 million. This loss is primarily due to interest expenses on those large reverse repurchase agreements, which were over $10 million. So while they aim for Bitcoin price movements, the financing costs are a big factor impacting their bottom line. Per share data shows for BitX a net realized and unrealized gain of 124 cents. However, when you look at the total return at net asset value, it's 3.74%. This difference tells a story. Much of that gain per share is from realized gains on futures contracts, ate into that, leading to a much lower overall compounded return than one might expect from just looking at the per share numbers in isolation. And here's that cost number we saw earlier, the ratio of expenses to average net assets coming in at 235%. This is a key metric for investors to watch, as higher expenses directly reduce your returns. On the 1+1 Nasdaq 100 and Bitcoin ETF, the total from investment operations per share was negative 2.55. This is quite a loss for such a short period, and it's reflected in their total return. And indeed, the expense ratio is a very low 0.75%, highlighting the trade-off between low costs and potentially volatile or underperforming assets, especially during nascent stages of the fund. The section on the basis for approval of the investment management agreement is crucial. It details the board's review of the services provided by Volatility Shares LLC. They consider the nature, extent, and quality of services, the fees charged, the advisor's profitability, and potential economies of scale. For the new 1+1 ETFs and the corn and wheat ETFs, the board approved management agreements noting that the advisory fees will cover all fund expenses except for things like brokerage commissions and extraordinary items. This unitary fee structure means the advisor absorbs a lot of the operating costs. They specifically looked at peer group fees and noted that these 1+1 ETFs might have higher expense ratios than similar products not registered under the Investment Company Act of 1940. This is a common argument from ETF providers when launching new specialized products. The compliance burden adds cost. Scroll, what's my take on all this? Well, these leveraged ETFs are clearly high-risk, high-reward vehicles. for BitX and FU. The performance numbers from the past year are a stark reminder that doubling daily moves can lead to severe losses when the underlying asset is volatile. The massive unrealized losses on Byte appeal to a niche. However, the reliance on futures contracts and the inherent risks of daily rebalancing remain significant factors. Essentially, these are complex products designed for sophisticated investors who understand the amplified risks and costs involved. The massive unrealized losses on BitX's futures contracts are a major red flag for that fund's current strategy. While the lower costs for the one but last one ETFs are attractive, their very short track record and heavy losses so far suggest extreme caution is warranted. The corn and wheat ETFs show more moderate performance, which might appeal to a niche. However, the reliance on futures contracts and the inherent risks of daily rebalancing remain significant factors. Essentially, these are complex products. Alright, that's our deep dive into the Volatility shares trust filing. What do you think about these leveraged and inverse ETFs? Are they a smart way to gain exposure, or are the costs and risks too high? Let me know in the comments below your thoughts. If this breakdown helped you understand these complex products, give this video a like, subscribe to Corporate Decoder for more insights, and definitely join our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next one.